What's up guys? Welcome back for another video. In today's video, we're going to talk about the government 401k, that is the government's Thrift Savings Plan TSP, because they have introduced new life cycle funds. Before we go any further, I must say that I'm not a financial advisor, I am not a CPA, I'm just some guy on active duty who contributes to the TSP himself, and I make YouTube videos trying to educate and help other people save and invest. Almost a year ago, I made a video on my channel titled "The TSP Lifecycle Funds Are Terrible, Here Is Why." I feel like all of the information in that video is still relevant and current as of today. I don't want to repeat myself, I'll link the video down below, but let's cover these new lifecycle funds and if they're a good deal or not. If you log on the TSP's website, you'll see them. They went live as of July 1st. So prior to this, there was just the L2020, 30, 40, 50, but now they've added increments of 5, so they can be a little bit more precise based on your age, retirement year, and it goes all the way to 2065. So that life cycle fund would apply to someone who was born in the year 2000, and they were planning on retiring at the age of 65. So they would be in the new L2065 fund. Now, the life cycle funds are not their own special investment funds. They are just fixed percentages and mixtures of the other original 5 funds in the TSP. Let's recap those real quick. The G fund stands for government bonds. The F fund stands for fixed income, which is corporate bonds. This is a bond index made up of numerous different kinds of corporate bonds. The C fund stands for Common Stock Index Fund. That is the S&P 500. That is the largest 500 companies publicly traded on the New York Stock Exchange in America. The S fund stands for Small Cap Index Fund, and this is an additional 2,000 or so smaller companies that are still publicly traded. They're just not in the S&P 500. And then the I fund stands for International Index Fund, and this includes companies like Samsung Electronics, Toyota Motors, Royal Dutch Shell, British Petroleum. So these are international companies. And in this video, I want to emphasize that if you were to select just one of these basic 5 funds, you're already well diversified. You're not putting all of your eggs in one basket, investing in Blockbusters or Enron or Hertz Rental Car. So, for example, the C fund. If you were to put 100% of your distribution in the C fund, you would be well diversified in the 500 largest companies in America. How this works is the percentage of the fund devoted to owning stock of that individual company is based on their market size. So, for example, Apple is about a little over a market cap size of $1 trillion. That makes up 1/30th of the total pie chart for the S&P 500. So what percent of the C fund is stocks, shares of Apple Electronics? It's about 3%. Same thing with Amazon, Google, Microsoft, Facebook, so forth and so forth. You're in every stock when you buy this fund. Now, what the life cycle funds do is they say, well, yes, all of our original 5 funds are well diversified and generally safe investments, but let's go ahead and diversify our diversified funds. So let's go ahead and click on the new L2060 fund and just check it out here. What's happening here is what's called a glide path, where you start primarily in equities, so this is stocks, and then you slowly, as you grow older, sell those stocks for larger percentages of bonds. So if we click on this little timeshare, it'll start advancing. But once again, I think it's funny that starting out at year 0 when you're investing in the TSP, if you're retiring in 2065, they can't help themselves. They have to put just a little bit in the G fund, a little bit in the F fund, even though it serves no purpose. You should not be buying bonds if you're 18 years old and you're not retiring for another 40 or 45 years. The distributions, gonna say it up front, I'm not a big fan. I don't like how the I fund is so large. Right away, you're starting with 34% in the I fund. We can talk about what returns the I fund has gotten historically. It's not as good as the C and the S. The reason why is politics is being played with the I fund right now. The I fund does not include China or other emerging markets like India or Brazil. It only includes well-established, older democratic countries like Japan, Australia, South Korea, Western Europe, Canada. And if you want a true index of the international market, you got to include the entire world. You can't just arbitrarily exclude China, India, Brazil, and all these other countries. So until the I fund is fixed, and this is a political problem that needs to be changed, I don't recommend people heavily invest in the I fund, especially invest 35% of their TSP contributions. In my opinion, that allocation is way too high and needs to change. We can go ahead and click on the time marker, and it just shows you over time what happens. For whatever reason, they increase the C and lower the S. I don't understand why they would do that. But after about, let's see, 10 years or so, they're going to start selling your equities, your stocks, and they're going to start transferring them to bonds, the F and the G fund. And let's see, if you're 65, then in 2055, you're within 10 years of retiring. And I don't like this. I don't like how within 10 years of retiring, you're already 25% in the G fund. The way that government bonds are looking in the future, I don't see interest rates going much higher. The G fund right now is averaging you less than 2%. Why, with 10 years to go until you retire, are you going to condemn 25% of your portfolio to basically maybe beat inflation, probably sometimes lose to inflation? I don't agree with this. Once again, I don't support the life cycle funds. I don't agree with these distributions. If you want my advice, what you should do is be 100% US equities, C&S fund until you're within 5 years of retiring. Within 5 years of retiring, if you like what your account balance is at, you can start moving it to bonds. I recommend the F fund, corporate bonds. They give a much higher yield and they're still low risk than government bonds. Now you might be saying, but Jake, 100% US equities, that's so risky, I'll lose all my money. No, you won't. That's not how it works. When you buy the S&P 500 index fund, you get the return of the S&P 500. Luckily, it's the year 2020, and we just had a financial catastrophe occur 3 months ago. So the stock market, the S&P 500 value was trading at 3,300 back in February. It then lost almost a third of its value. It dropped all the way down to 2,200. Miraculously, in the last 3 months, it's basically recovered all of its losses. But even if you look at that 33% dip in the US market and put it in perspective, it's still not that bad. If you just look at the S&P 500 over a time horizon of 5 years, in March 2020, it bottomed at 2,300. That's exactly where the market was in February of 2017. Yes, being set back 3 years worth of your investment is bad, but it immediately recovered anyways. It always recovers. If you just zoom out and you look at a long enough timeline of what the market does, it always goes up. If the market ever went to zero, then the United States government has collapsed. The dollar is worthless and society as we know it has ended. I do not believe that's going to happen, and there's no reason why you should be planning your future for that happening. Big picture, when you look at the individual annual returns for these funds, you can go ahead and say, what's the 10-year average? The G fund, 2.23%. The F fund, 3.99%. The C fund, 13.59%. It's been well over 10% since its fund inception. Same thing with the S fund, 13%. If you want to get 13% a year, or since its inception it's averaged over 10, then be in US equities, the C fund, the S fund. The I fund is terrible. It's been only averaging 5.85% the last 10 years when the economy was good. Once again, with these individual funds, if you want to look at the total historical returns, the TSP was created in 1988. You can get the average return on your money going back all the way to 1988. So in 1989, the C fund was up 31%. 1997, it was up 33%. There are down years, 2002, down 22%, 2008, down 36%, but then there are up years, 2013, up 32, 2019, up 31. And when investing for retirement, there's a useful rule of thumb that you can keep in the back of your mind to help you keep your eye on the prize. And this is called the rule of 72. And basically, when you invest your money at a certain percent return, you can determine how often your money will double. If you talk to a TSP millionaire, there are thousands or maybe tens of thousands of people who have invested in the government TSP and are now millionaires. They will tell you they have been in the C fund, they have been in the S fund, they have not been in the G fund, they have not been in the Lifecycle funds. So if you invest your money with a 10% return, which is what the C and the S average in the long term, then your money will double every 7.2 years. If you invest and get 9%, your money will double every 8 years. So if you had $100,000 at age 50, for example, by 58, you should have $200,000. And if you add 8 to 58, you would then be 66. So you would then have $400,000 in your retirement account. So the power here is to stay in U.S. equities. It's really important that you do not try and time the market. The market will go down. Do not sell. Just keep dollar cost averaging in. If you've already left government service and you can't contribute anymore, just stay in U.S. equities, stay the course. Do not react to the news. You're not investing on a time scale of days, weeks, months, or even years. You're investing on a time scale of decades. In conclusion, I'm still just not a fan of the Lifecycle funds. I don't think they serve your individual needs. It's a one-size-fits-all robo-advising, fixed percentages, ignores the news, doesn't take into account what your investing goals are. So definitely do more research. I'll include my playlist of TSP videos down below. There are other YouTubers that talk about the TSP. Definitely ask questions. There are Facebook groups and forums and Reddit threads that you can join. The TSP is very important because this is your future, this is your family's future, and this is something you definitely want to get right. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, if you haven't subscribed to my channel, consider subscribing. I talk about finance-related issues. And if you have any comments or questions, leave me one down below. I love hearing from you guys. And until the next video, take care.